Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you a brief market summary for the week ending September 20th, 2024. I'll then move on to looking at trading levels for next week of September 23rd. We'll take a look at the major market index ETFs, and then we'll look at some popular company symbols. So right here, we're looking at the SPY, the ETF of the S&P 500, of course. And this week we hit an all-time high this on Thursday, and that was spurred by the Federal Reserve dropping the federal funds rate by 50 basis points, and that spurred a big rally on Thursday. Today we gave back about 4 points or so, and so we're sitting within a whisper of the all-time high. So that was that's that price action right there. If we take a look at the Qs, which of course is the ETF of the Nasdaq, we pretty much see more or less the same kind of price action here. However, its all-time high is actually back in July. If we go back here a few weeks, we can see right there. There's the all-time high from mid July here. So we're sitting about 3% or 4% away from that. So that's where we are now on the Qs. If we take a look at the Russell 2000, we're actually sitting about 2 or 3% away from its 52-week high, which are those blue markings there. However, its all-time high is actually sitting about 3 years or so ago. Here's a weekly chart of the Russell, and right here, that's more or less of October or so of 2021. And so that's about 3 years or so ago. So we're obviously about 10% away from that. We're sitting around 221, and the high there was about 244. So that's about 3 years or so. So right there, there's the 52-week high, but there's the all-time high. All right. So that's the story with the major market indexes. So before I get on to the trading levels, first of all, usual disclaimer: nothing here is investment advice. We're not money managers or financial advisors, and everything is for information and educational purposes only. Before I get on to the trading levels, I want to show you a couple of recent trades that I had with Morgan Stanley, because they actually are good illustrations of how the trades are put together and the specific foundation for our trades. So I figured it would be useful to kind of go through that briefly so that you have a background as to what I'm doing here, so that when I show you the other symbols, you'll have an understanding of what's behind them. All right. So here is what I was looking at on Morgan Stanley here. So this is mid August. So this is approximately about a month or so ago. And this was the daily chart of Morgan Stanley here. And my eye was drawn to these two particular levels here that I had marked out at the time. And so let me kind of go through the narrative of what was going on here. So if we take this bottom level here first, okay, so right here, this was about 2 days or so ago, prior to where we were here. And what was going on here was price had consolidated in here. And then, of course, notice that it's a very, very bullish sudden move out of this region here. And so what was going on in this region were that buyers and sellers were more or less in agreement within a relatively narrow range of, let's say, basically this is about a little over $2 range in here. Okay. And so within here, buyers and sellers were in agreement here. And then all of a sudden they went out of agreement because of the fact that there was an exhaustion of sellers. No one was willing to sell here anymore. Okay. And so if we think about this region in here, and we think about the shares that are acquired by buyers, we can think of that as the demand for shares. Okay. And then we can think about the shares that are offered up by sellers. We can think of that as the supply of shares. Okay. And so within this narrow region here, buyers and sellers were in agreement. And so there was supply and demand were in agreement in here. And then all of a sudden, from this exhaustion of sellers, there was no longer any supply anymore. There was only demand. Okay. And so what was left in its wake, we think of as a demand zone. Okay. And so when price returns to a qualified demand zone where there was the consolidation that was very brief, okay, and then all of a sudden there was an exhaustion of sellers, okay. When price returns here, if a demand zone meets certain criteria in terms of its structure, in terms of the price action within it, and then in terms of the exit, in terms of the energy and distance that it goes. When price returns to a demand zone, that is where we can express a bullish trade. Okay. And so right here, I have this noted out here. And of course, the obvious ways one could express a bullish trade from this region, of course, one could simply buy the stock. Okay. One could also buy a call, okay, in terms of, looking to capitalize on a bounce from this region, okay. And also, if one, let's say, wanted to collect premium, one could sell a credit spread, at which point then one doesn't even necessarily need to get any kind of major bounce, but price just simply does not drop any further, and then one could, of course, capitalize on time decay. Okay, but for all of those different ways of expressing the trade, they're all predicated on getting a bounce from this level here. Okay, and that's what we expect to happen from a demand zone. So that's the basis for a bullish trade from when price returns here. And the way a trade is constructed, though, is this is where you would get in at the front line of the zone, and then obviously we're looking for and expecting a bounce. Of course, it's trading. And so of course, numerous times we are going to be wrong, or I should say the market will not cooperate with our thesis. And so when those levels fail, this is where our stop out is. Okay. And then the distance between our entry and our stop out point, that of course is our risk profile. And so the rungs of this ladder here correspond to risk. Okay, so this is one unit of risk that we would lose if the trade didn't work. Okay, if it got to here, that would be a 1-to-1 trade. If it got there, it would be a 2-to-1 trade. Got there, it would be a 3-to-1 trade. Okay, so that's the story of a demand zone. Okay, above here is a supply zone where you had an exhaustion of buyers. Okay, there was no longer any demand here. Okay, and so where supply and demand were in balance here, once the exhaustion of buyers occurred, what was left in its wake was only supply. Okay, and so when price returns to the supply zone, it's the exact opposite of what I explained down here. Okay, so up here, of course, the obvious things one could do would be to short the stock. One could short Morgan Stanley up here, and of course, one could also buy a put. And then again, if one wanted to collect premium, you could sell a bear call vertical credit spread. And again, as long as price didn't really drive through this zone, that would be a winning trade, because essentially then while time was being wasted up here, or if we got the push down, one could of course then capitalize on time decay, and then and then with any luck, the option that you would sell would either expire worthless, or I should say the spread that you sell, or if it doesn't expire worthless, one of course could buy that back for a significantly lower price, and then at that point, then you make a big partial profit on that. So one way or another, though, those are all different ways of expressing a trade out of that supply zone. Okay, so now if we flash forward to what actually happened here. Right here are those zones that I just showed you. Okay, and so that was all set up in the middle of August. Okay, so price came up here. Okay, and that was on August 26th. It hit the front line here. It took a better part of a week, and it just kind of stuck there for about 4 or 5 days. But then eventually, it then pushed down, and so that was the basis of a nice bearish trade here. And so what we had done here was, from that supply zone here, is that we bought a put. We bought it out into November. So we bought it out with about about 10 or 12 weeks, I guess, of time. And we do that so that if we get stuck in the trade, we don't get too beaten up by time decay. So we ended up buying a put for about 550 at 103.05. Okay, that was the front door of that supply zone. And again, that's our stop would have been up here at 104, actually about almost 105. Okay, so that's where our stop would have been if the trade did not work out in our favor. But eventually, then it did drop nicely, and we got out of this here. So on the underlying, it was about a 3-to-1 trade, and obviously, then in terms of the option, um, we ended up accruing what is that, about a $3.50 profit on that 555. Okay, so the premium went up to about $9 there, and so that 350 premium increase represented a 60% win on that. Okay, so that was a nice trade off of that. And then when price eventually came down to here, we ended up pulling the trigger on buying a call here, and so that's where we got in here. And it's the same narrative here. At that point, because 2 or 3 weeks had passed from here, rather than buying the November, we bought the December, so that again we would have about 3 months to go, so that more or less the theta on the option would have been relatively innocuous. So price came in here, and unlike this one where it kind of took its time getting out of the zone, it really just a couple of days and it was off to the races there. And so we actually closed that trade out today. Um, figured we already got a nice profit out of it. We didn't want to sit in this over the weekend, so we just decided to kill the trade today. So right here was our initial premium, was 860, and we went up to 13 and a quarter, and so we made a little over 50% on that over the course of what is that, about 10 days. Okay, it got into this on the 10th, and we got out of it today on the 20th. Okay, so that's the foundation of what our trades are. They're all based on the supply and demand levels, and then we can express either bullish or bearish trades. Bullish trades out of demand zones, and then bearish trades, of course, out of supply zones. All right, so that's the deal with our trades. So now what I'm going to do is I'm going to start flipping through some of these symbols, and we'll go from there. All right. So here we'll start out with looking at the SPY. Okay. And so right here was what I showed you before with respect to the market wrap up. So here's the chart of the SPY though. Okay. And if we drop this down to a 2-hour level here, you can see I already marked this out here. There's a 2-hour demand zone sitting right here. Okay. So if I can change this to a 2-hour chart here. In fact, actually, I think this was actually a 1 hour now that I think of it. So right here, this is the basis for a trade that if and when we get a pullback to here, this is where we would express a bullish trade here. Okay, and so the way one would do this is, again, when I showed you this on the Morgan Stanley chart, is this is where the entry would be approximately. Okay, the stop out would be behind here, and what we typically do is we use the range of the zone here, and then we'll also give it a little extra wiggle room based on a percentage of the daily average true range. Okay, and so that would be the foundation for a bullish trade here. Okay, and so again, we'd be waiting for the pullback here, and then this is where we would either buy the stock or buy a call, and of course, or one could sell a credit spread. All right, so that's the story with the SPY. We're sitting in an all-time high here, so at this point, we really don't have a qualified supply zone here because we're sitting in an all-time high. So for the moment, there's really not much else to talk about with respect to this. All right, so if we move on to the triple Qs for the excuse me, for the Nasdaq, right here, we're actually sitting in a level of more or less what we think of as tested supply. Okay, what I showed you before on the Morgan Stanley chart, or in fact on the SPY chart just now, that was fresh supply or fresh demand. In other words, when price has not been backed, once the level is formed, price has not returned there since. Okay, so right here, this was a fresh supply zone here at the time. Okay, price came up here, rallied, okay, consolidated, dropped, okay, with a great deal of energy. There's a gap, major bearish candles there, okay. And so when price returned here, okay, this was the first test, okay. And if one in fact gave themselves enough wiggle room, it had actually gone through the zone just a little bit and then dropped fiercely from there. Okay, so that could have been a trade. And then right here, price was now back here for a third time. Okay, so this was a fresh supply zone, but it's no longer fresh because now it's been back. In fact, this is now the second test. Okay, and for us, the first test is best, as the expression goes. Okay, so it's quite possible that a supply or demand zone could certainly work more than once, but each time price returns, it's a lower probability trade. And so generally, we're only trading fresh zones on either end. Okay, so right here, here's where we are now. So really, we're not looking to trade this here. Okay, nor are we looking to trade this down here. This was a fresh demand zone here at the time, but now it's a tested demand zone. Okay, so for us, there's no trade here. Okay, on the other hand, if price moves up here again and threatens the all-time high, that would be a potential for a bearish trade. Okay, what we would probably end up doing though is not take the trade at the front line. We would actually wait to see if price drills into the zone. We would then look for a confirmation entry, for price to roll over, and then at that point we would take the trade once it's going in the right direction. And the specific reason for that is oftentimes at either 52-week highs or all-time highs, oftentimes price, will actually just drive right through it. So depending on market conditions, I wouldn't just be racing to immediately take a bearish trade at the front line here. So that's what we would be looking at there. All right. Taking a look at the Russell. Okay, so here's where we are on the Russell here. Okay, so here's that level here at about 228 to 233. And in fact, this is the level, I believe, that goes back 3 years. Okay, this is that supply zone. Okay, that from the all-time high that was hit in November of 21. Okay, and so if we go back, that's the level right there. Okay, we have a drop, a base, and that drop there. Okay, notice price consolidates. There's the exhaustion of buyers here. Okay, and so when price returns to this level and has not been back there since, with the exception of like this one minor little kiss at the front, that front line, but for all intents and purposes, this is a fresh supply zone here. Okay, and so when price returns here, this is where we could express a bearish trade. Okay, and again, one could short it, one could buy a put, one could sell a credit spread up there. Okay, and in terms of then a demand zone here, I'm looking at this one here. Although at this point, this really didn't go far enough, and there really wasn't enough follow through. So in fact, this is really provisional here. So in fact, actually, I probably would not be taking a trade there now that I'm looking at it. And then after that, this is already a tested zone here. Okay, so I would not be really looking for any kind of near-term trade here. And in fact, I believe the nearest fresh demand zone is actually down here. Okay, if we go back here, see right there, that's a tested zone. And then the next, like I said, the nearest fresh demand zone is right there. Okay, so that's at the 187 mark. Okay, so you'd need a fairly substantial pullback in order to get there. That would be like, in fact, that's a long way down. In fact, I'm not rooting for that to happen. That would be 40 points down. So there's really no fresh demand, at least in the context of either the daily chart or even a 2-hour chart, until you get much further down. It's quite possible, when somebody breaks this down into a 15-minute or a 5-minute, yeah, there are certainly going to be some intraday levels for some quick bounces. But in terms of any kind of swing trading levels, that there's really nothing there until we get much further down. So that's a story with that's a story with the Russell. Taking a look at Meta, move on to some stocks now. Okay, so right here, we're looking at the daily chart here. This is a drop base rally formation. Notice price consolidates. Okay, we have an outside gap there. Then there's a pause, and then it kind of goes from there. Okay, so in terms of where we are now, that's a fair distance away. It is about 10% away from here. But if we do get a pullback on that, the trade would look something along like that. Our stop would be just a bit behind. Okay, and so that would be the basis for expressing a bullish trade at roughly at about the 508 level. And of course, notice within that there's also the psychological round number of 500. If I drop this down to a 2-hour, just want to see quickly here. There is this level right in here. Nah, not too impressed with it. So in fact, I would not be looking for that. One of the things that we do here is, we try to basically be picky. There's no reason to take a B or a B plus trade when you can just as easily find an A or an A plus. So as we tell our subscribers, not every chart has a level, or at least not every chart has at least a level that we approve of. All right, so taking a look at Apple here. So right here we have a drop base rally formation there. This is actually a level that we like. So this is about 5% down from where we are here. In fact, let me go back to the other daily chart here. So you can see right there, price dropped, consolidated, rallied. Okay, notice there's a major gap there. Very bullish candle here. So again, we have that sudden exhaustion of sellers here. So the thought is that there is either literally unfilled orders here, or if they're not unfilled orders, this is an obvious area of interest where institutions and retail traders wanted to buy. Just not everybody got the chance to do it. And so when price returns here, this is where we would expect a fair amount of time that we're going to get another bounce out of here. And then this is where, again, we would express a bullish trade. That would look more or less like that. Okay, so that's the story with Apple. You can see right here also there's a rally-based drop formation. Price has come up here, kind of came up here once. In fact, bumped against it here, because at its most aggressive, you could actually draw the supply zone like that. And so you can see, using the full length of that descending wick here. And if you notice right there, if you express this at its most aggressive, in fact, price came up and dropped out of there. So in fact, this is technically not considered to be a fresh level anymore. And you can see price has now come up here a second time. So we'll see what happens here. Probably at this point, I would not be looking to short it here. On the other hand, right here, this demand zone here, I do like that. So we'll be waiting for that. So that's sitting at around That's sitting at around 216.70. Okay, so that's where the demand zone on Apple is. Taking a look at Amazon. Okay, we have this demand zone right here. Okay, so price dropped here. Notice now it's that entry candle engulfs this little base candle there, and notice price then rockets out of there. There is a little pullback there, and then it kind of goes. But I think this is a reasonable level here. Now, having said that, that's a fair distance down. That's about 8% down. So you'd need to, but that's in terms of, again, we wait for the trade to come to us, and that's also the beauty, of course, of trading stocks, is that there are hundreds and hundreds of stocks. So, in fact, there are thousands of them, but there are several hundred, that have appropriate liquidity, and that are good trading vehicles. And so, if you don't find something in one, you just move on to a different symbol, and you don't try to force something. So for the purpose of this, we would simply set an alert so that if it does pull back at some point, we'll be ready here. And of course, if there's some subsequent price action here, there could be a demand zone that forms higher. But as this stands now, there isn't one. But again, when price pulls back here, it could create a zone at some point that's closer to where we are now. So there's that. Okay, right here we have a base drop formation here. Okay, and so we're actually kind of heading towards that, and we're not very far from that at all. So in fact, this might actually be someplace that we would express a bearish trade. Okay, and so again, the way that would look would be more or less like that. Okay, and again, one could buy a put. If we're going to buy a put, we would probably want to buy it out, let's say with at least 2, preferably 3 months of time, so that if we do get stuck in the trade, we're not going to be beaten up too badly by time decay. Having said that, Amazon and certain stocks that are highly volatile, the options, the options will get very expensive. And so at that point, then we might end up doing a debit spread. And of course, our preference would be to buy it a bit in the money, but we might actually, if they're very expensive, we might either buy it at the money or even a bit out of the money. So we would, obviously, do our options analysis and see where that lies. All right. So that's the story with Amazon. So we have a demand zone here at 175, which is fairly, about 8% down. But then there's the supply zone here that's very close to where we are now. Taking a look at NVIDIA. And if we break this down to a 2-hour chart, which I have a note here. So notice right here, we have a drop base rally formation. Notice price rockets out of there after this very brief consolidation here. Okay, and so this is where we would look to express a bullish trade with NVIDIA. Okay, so again, that's about 7 or 8% down here. So more or less, again, that's something we're going to have to wait on. But that's what we would be looking at. Okay, above would be this level right here. We have a drop base drop formation. Okay, right here we had a drop base drop formation, but this is now a tested level. Okay, price came in here. Okay, and then drop from here. Some people, of course, would think of this as a double top. In fact, it's now been back a third time. So none of this we would have no interest at all in looking at a short trade here. So at that point, then the next clean level here is right there. And so that would be what we would be looking for a bearish trade. Okay. So right here, this is what our level would look like. And so we would need to see a rally up here. So that would have to be about 7% up from there. So in fact, we're actually kind of sitting midway, really between two qualified supply and demand levels. Okay, one above, one below. And in fact, depending on options premium, this is actually an ideal situation for writing an iron condor when you're sitting midway between levels. Depending on what the options premium is, you can actually basically do an iron condor where you would have your short strike somewhere in here and your short call sitting somewhere down. Excuse me, your short call up here and your short put down here, and then that basically you're using these levels to effectively help to shield the short option. Okay, so that's that's Nvidia, and then we'll take a quick look at Netflix. And let's go back to the daily chart. Okay, so right here we have a rally-based rally formation. This is a real nice level here. Again, this is just a whole lot of congestion over here, and so again we're going to need to see some kind of pullback here on the 2-hour chart here. Right in here, this was a 2-hour demand zone here, and in fact, some of our subscribers actually had some nice trades with this, but now this is now a tested level. Okay, so if and when price comes back here, as far as we're concerned, this is now this is all spent. There's nothing to see there. So in terms of demand, that's the first fresh demand zone, and that's sitting at 635. So obviously, again, you would need a significant pullback, but I'm expecting at some point we're probably going to see something like that. So that's what we'll be looking at on Netflix. And we'll finish up with Google. And in fact, Google, we've actually been looking at something here. So right here, there is a supply zone here. Okay. And so when price gapped up in yesterday, or I should say on Thursday, when that occurred because of the Fed rally, price gapped into there. So we didn't want to necessarily, when it gapped up here, we didn't automatically want to short this. And in fact, so price came out of here. And so the thought was we would actually be waiting for what's referred to as a confirmation entry. Okay. And the confirmation entry, once it went into the zone, is you wouldn't sell it when it's in the zone, but you would wait for it to turn around and then actually emerge from the other side and then get into a bearish trade here. And so, in fact, we had set this up looking for a bearish trade on a confirmation entry. And I believe what I did was I advised people to wait till this thing got to 134.20. And so that, 163.20. And so that was about here, about 20 cents below that front line there. Okay. And so that was what we've been waiting on. Okay. So, and what we want to do is we actually want to see a very strong bearish 1-hour candle. Okay. And so we thought we were actually going to get this today, because if you look at if you look at today's candle here, let me just blow this up here. This was obviously at some point today, this was actually a big red candle. Okay. Because it opened here. Okay. And so this thing was all red. But then eventually, over the course of the day, it recovered everything and, in fact, actually closed up. So where this was a huge red candle here, it actually turned green. So we thought that we were actually going to get an entry on this. Okay. But in fact, that did not happen. Okay. So now we're going to wait for this. We'll see what happens on Monday. But if that doesn't really happen, then at that point, then we'll just be done with this level. And at that point, then we're going to be waiting for it to get up here, and then that's where we would express a bearish trade out of that, and that's sitting at around 172 region. All right. So anyway, that's what I got. So thank you for the privilege of your time. This is Mitch Firestone with Precision Trading Labs, and I will see you all next time. Take care. Bye-bye.